Hello, everyone, and welcome to Buck Stops Here. I am Catherine Murray. Well, we certainly are seeing central banks around the world in focus this week, with the U.S. Federal Reserve ending their two-day meeting today, as well as the Bank of Canada lowering rates by 25 basis points, and also indicating that this might be the last for quite some time. To digest all of this news and the outlook for the economies, we are joined by Sal Guatieri. He is the senior economist at BMO. Sal, great to be with you today, and thanks so much for joining us. There is a lot going on and to discuss.
There is, Catherine, yes.
And why don't we first start with the US Fed and what we learned from them today and what you expect to see for the rest of the year and also into 2026?
Well, what we learned from the Fed is, as widely expected, they did cut rates for just the second time this year, simply to address downside risks to employment, job growth, at least until the data flow came to an abrupt halt. It's been pretty soft in the US, and other private sector indicators suggest that softness continued right up until the current period. So, for largely for that reason, the Fed did see the need to trim interest rates further. But importantly, it did signal or fail to signal that it's prepared to move again at the next meeting on December 10th. In fact, in the post um, uh, uh, po- announcement meeting, Chair Powell basically just said December is not a foregone conclusion. So it'll come down to the data flow. Now, hopefully, we will see this government shutdown end, and we will see that the data starting to flow once again in the U.S. So the Fed will have a better indication of what's happening in labor markets and the economy. But for the most part, it will come down to the data. Now, we do still believe the Fed is on track to cut interest rates again in December for a couple reasons. Number one, policy rates are still significantly above the so-called neutral level that most Fed members deem is desirable for the economy, and that's close to 3% rather than the current rate, which is just under 4%. And the other reason is that back in September, a slight majority of policymakers were penciling in two rate cuts for this year, two more rate cuts for this year. So we did get the one today. So we still suspect that a slight majority of policymakers are leaning towards cutting rates one more time in December. And then getting into next year, we anticipate three more rate cuts beyond December. So ultimately, we see the Fed funds rate getting just below 3% by the fall of next year.
Which sound, that's quite a bit of loosening. And I wonder if, and this is always the argument, does the economy need that much loosening? And because there's always repercussions. We've seen it when they failed to tighten, and then we've seen they tightened too fast and too abruptly. Um, do you not see it almost going the other way? What's the rationale for lowering the rates further if, in fact, there are some areas of the economy that are quite strong?
Yeah, it's a good point, a valid point, and we may very well end up with no further Fed rate cuts between now and the end of next year. Say if inflation remains sticky and above the target, if the labor markets and the economy just rebound in coming months, that would probably put the Fed on hold. But our general sense is we'll probably see ongoing weakness, at least in the labor markets, for the next several months or so. The U.S. economy has slowed this year, not as much as initially anticipated, but the trade war has had some negative impacts on activity. So we do expect the peak of those impacts to play out in the second half of this year, and probably will push the unemployment rate in the U.S. up modestly further to around 4.5%. And the Fed's view is that the unemployment rate closer to 4% or just over 4% is more representative of a neutral rate, a balanced rate that keeps inflation steady. So if you're above that rate, then you generally need to get your policy setting back to neutral. And as I noted, that neutral rate is thought to be closer to 3% as opposed to the current rate, which is just under 4%. So it's not so much adding stimulus to the economy if they cut further, it's just kind of rebalancing policy and getting it back to more normal setting. But you're very right that if we see any upside surprises in the economic labor market or inflation data, the Fed probably would not be cutting rates.
But your point is well taken that we are quite a bit above that desired rate at around that 3%. And importantly as well, we'll talk about this on the other side of the break, is, where is the inflation coming from? Tariffs. We have yet to see that, surprising many people. We'll take a quick break. We'll be right back.